Hi everyone, welcome to Forex Trading Empire YouTube channel. In this video, I'll be talking about candle range theory, also known as CRT. So I'll be talking about what is CRT, importance of CRT, how to use CRT to anticipate reversal, and how to use CRT to anticipate trend continuation. So before I start, make sure to like and subscribe to the YouTube channel. So I know you guys have been hearing about CRT, and CRT have been one of the top topic in the trading community, mostly in the YouTube channel, in YouTube channels and in Twitter. So CRT is just a name given. It's still the same thing to a total soup of liquidity, which ICT have mentioned in its many tutorials. CRT is still the same thing to total sweep. It's just going into more details on how to get a direction using total soup, which is being given a name now, CRT, using the candles range to determine the directional bias. So in this video, we're talking about what is CRT, importance of CRT, how to use CRT to anticipate reversal, and how to use CRT to anticipate trend continuation. So CRT, candle range theory, is the act of understanding that every candle is a price range, which we have talked about that in every candle there is a price range where there is always going to be an open price to a closing price. So understanding that CRT is combining those candlesticks to anticipate the next candle's price movement, to anticipate the next movement of the next candle. That's the whole concept of the CRT, understanding the range of each candle to anticipate the next candle movement. If price was to sweep the previous day high or previous day low, you'll be anticipating price to trade to the previous day low or previous day high. So without wasting more time on this, let's move to the next slide. So how to use CRT to anticipate reversal. So if price runs into a higher time frame PDRA, let's start from a reversal from a bearish trend to a bullish trend. Let's say price trade into a sell side liquidity. For you to get a clear bias on where the price is going, because this CRT doesn't work on any, let me just say, on any price or in any area. It works on specific areas where price is either running a buy side liquidity, running a sell side liquidity, or feeling an imbalance. That's what you just need to understand about CRT. Trading CRT alone is just like trading a pattern. You have to understand that the CRT, you have to combine it with the PDRA metrics. If you understand the PDRA metrics, and applying the CRT will be an easy factor, to be like the last ingredient to make your trading more easier and to make it less complicated for you to find your daily bias, weekly bias, or even section bias. So understanding that if price runs a sell side liquidity, and in this first area here, you can see that there are three candles. One, two, three. If you look closely, this candle is only indicating accumulation, manipulation, where the second candle manipulates the first candle's low, which now is being called a CRT low, the candle's low. The second candle manipulated the candle's low, but did not close outside the range of the candle. It reversed into the range. Then you'll be anticipating the third candle to run the candle's high. So that is how that is what CRT comes down to. It's just an indication that price is ready for a reversal. It gives you a clear bias on knowing when to wait for you to see a total soup of the previous candle's low, or let me just say the previous day low, when looking for a sell side to a buy side delivery. So if you look closely, price runs the CRT low before heading to the CRT high. So at the early stage, you'll be focusing on the third candle, waiting for the second candle to close. You wait for the second candle to close, then you anticipate the next price, the next candle or the next price movement to go to the candle's high to run the buy side liquidity, which is known as the CRT high. The same thing applies to the from a buy side to a sell side delivery in a reversal. You don't just use this at any area which I've mentioned. You trade this based on a PDRA matrix. If price is trading into a buy side liquidity and you are anticipating a reversal, seeing a move like this gives you a clear indication where the first candle is the accumulation candle, which is the range candle. You want the second candle to run the first candle's high, close inside the range of the first candle. Then after closing inside the range of the first candle, then you anticipate the third candle to drive lower, running the candles low. So that is just the main thing about the CRT. It's the same thing to a total soup, which I've mentioned earlier before reaching this part of the lesson. The second candle is doing the total soup, running the first candle's high. So price runs to the first candle's high, then you anticipate the third candle to run through the candle's low, which if you are new to the concept of total soup or you are new to ICT, your main focus will be on the third candle. You rather stay away from the second candle. You just need to get a clear indication for price to give you its hand for you to trade on the third candle. So here is a chart example. If you look closely in this chart, I did not mark out the PDRA matrix. The main focus of this lesson is about the CRT. But if you look closely, you can see that the third candle traded into a fair value gap. The third candle traded into the fair value gap between this candle, this first candle, the second candle, and the third candle, forming the fair value gap. You can see that if you're anticipating price to trade into this fair value gap, saying that the second candle, let me say the last candle before the blue candle, retrace into the range of the first candle, into the range of this candle. So seeing an indication like that gives you a clear indication that this is a CRT based on CRT, but this is a total soup. It's a CRT level where you're expecting price to run through the CRT high into this fair value gap. You are still using the same concept to the PDRA matrix where you're identifying a run on liquidity and the next draw on liquidity. Without knowing where price is going to and where price is coming from, trading the CRT would be like trading a pattern which wouldn't be profitable in the long run. So I'll be zooming down on how you should have taken an entry on the third candle. So zooming down to the third candle, so you can see the line indicating each candles. If you were to use a daily bias, you'll just be applying a classic buy day where you'll be expecting an opening price. You'll be expecting an opening price, a manipulation below the opening price, and a distribution above the opening price heading to your target. So you can see in this chart, you can see our price traded to the top, runs down, go below the opening price, running out sell side liquidity. I did not mark the PDRA matrix because the main focus on this is just an intro to the CRT concept, which have been trending a lot. I just wanted to touch on the topic. So price run through the low before pushing to the upside, which in the Forex trading empire community, we have talked about the power of three is one of our based concepts, which was derived from the ICT concept power of three. So price run through the low, running sell side liquidity before pushing to the upside, creating a classic buy delivery. So getting a clear direction using CRT is knowing that you're expecting a clear, you're expecting a bull run to the upside. You're expecting a price movement to the upside. So it gives you a clear bias. It helps in giving you a clear bias, which I've checked really help trader giving them a clear bias when it comes to determining a bias. So if you wait for a CRT formation in an area where you're anticipating either a reversal or a trend continuation, then I know that then CRT will be a great deal to your analysis, or let me say a great deal in helping you determining directional bias. The same thing goes to a bearish CRT where price runs out the first candle's high, then you anticipate price to run the candles low. So looking at this chart, if you notice that the first candle runs out buy side liquidity, price running out buy side liquidity, if you're anticipating a reversal, you're anticipating even if it's a pullback to the 50% PDRA. So that's why you need to understand the PDRA metrics before even thinking of using a CRT theory. So price runs through the buy side liquidity. Running through the buy side liquidity, the second candle runs through the CRT high, close inside the range. Then you anticipate the third candle to go for the CRT low. So you see how easy it is that if you're seeing a first candle's run, you wouldn't look for sell immediately. You wouldn't start looking for sell immediately. You wait for a CRT formation. It's just it's just like a confirmation to your bias. And you see that the second candle runs to the first candle's high, traded into the range. Then that is a clear bias for you to look for sell. Because now you have seen the accumulation, the manipulation phase, and you're just waiting to get into the distribution where there's a high volatility, where there's a high chances of price reversing down to either the CRT low or targeting more further targets like a sell side liquidity or into a fair value gap. So the CRT helps you in knowing when to wait and when to find a setup. So zooming down into the 1 hour time frame, you can look at the first candle trading to the upside, the second candle. So that's why I say stay away from the second candle, because if you haven't have more experience in trading a total soup or trading all ICT, trading all the ICT concepts, then you stay away from the second candle. If you are new to this, stay away from the second candle. Your focus will be on the third candle where there's a higher chances of price running the CRT low. Well, we that are trading total soup, once price runs through the previous high, we'll be expecting a reversal to either the mid range. So there's still more details in the total soup, slightly different from a CRT. But in a CRT, you wait for the candles close, then you anticipate the next candle to provide the move down. So which you can look in this chart, you can see how price traded into this order block, and you can see the reaction away from the order block, trading to the CRT low. So how to use CRT to anticipate a trend continuation. So if you're expecting price to run through, let's say run through a fair value gap or run through a buy side liquidity, and in a candle form, we just say you're anticipating a day, you're looking for a specific day for you to find a buy to that buy side liquidity. We'll first start from a bull run. Then the first candle closed and the second candle closed above the first candle's high. That's a clear indication of the next candle producing more higher prices. So that's how to anticipate higher prices using the CRT theory. The first candle, the second candle must run through the first candle's high, giving you a clear indication that the third candle will be a higher price candle. The same thing goes to a bearish trend. If you're expecting lower prices into a fair value gap or into another block, or into a sell side liquidity, if the second candle closed below the first candle's low, will mean a body candle close below the first candle's low, then you anticipate the third candle to produce more lower prices. So here's a chart example. So you can see the first candle. You can see the second candle close above the first candle's high. Then we anticipate the third candle to create more higher prices. So move to the next slide. You can zoom in down to a 1 hour time frame. You can see the opening price, below the opening price, then trade above the opening price. A classic power of three. So using a CRT is very, very easy for determining bias using it when you are applying the PDRA metrics with it, because that is the main factor of knowing the next draw on liquidity. So aligning those factors, I think, is one of the major key which will help in you determining bias, which I might later, if I see a big reaction to this video, I might do another video where I'll be combining the PDI metrics with the CRT, how to combine using the PDA metrics and using a CRT for more confirmation to know a specific day which you'll be looking for buy or a sell. So in this diagram, you can see how price traded below the sell side liquidity, then pushed to the upside, creating a classic power of three from the opening, manipulate, then distribute to the upside. Same thing goes to a bearish trend. You can see the first candle close, then the next candle close below the first candle's low. Then you anticipate the third candle to close below the second candle's low or create lower prices. Zooming down to a 1 hour time frame, you can look at the second candle. You can see how the second candle closed below the first candle. Then a classic power of three. You just expect a classic power of three in the next candle, where there will be an opening price. It manipulates on higher prices, running buy side liquidity. Then you expect lower prices after the manipulation, which is a classic power of three from the opening price, accumulation, manipulation, and distribution. So we added the CRT theory to the Forex trading empire just to help our beginner trader to understand more on knowing the specific days to look for a setup. So if you're interested to join the Forex trading empire community, the link will be linked in the description below. You join the Telegram channel and you chat up the admin to give you more information on how to become a member of the community. So that is all for this video. There's more to CRT than I explained in this video. This is just like an intro on understanding why the CRT have been one of the major topics, because it has been helping traders to understand and to know its specific days to expect either a buy or expect a sell trade. So more might be posted in this YouTube channel, but more on the CRT has been discussed in our community. And that's all for this video. So make sure to like and subscribe to the YouTube channel. See you guys in the next video.